Welcome to DLSN, a podcast brought to you by McGuireWoods. DLSN promotes the advancement of women in private equity and finance through conversations with women in the private equity and finance space. These conversations provide both insights and practical takeaways to inform your deal work and enhance the culture of your organization. If you're ready to drive the industry toward a more inclusive and diverse environment, then it's time to come to the table.
Hello, and welcome back to the DLSN podcast hosted by McGuireWoods Women in Private Equity and Finance Group. I'm Kelsey Hitchcock, and today I'm joined by SC Moatti, the founding managing partner of Moatti Capital, a Silicon Valley venture capital firm. Hi, SC. Welcome to the podcast.
Thanks for having me. Great to be here with you, Kelsey.
It's great to have you with us today. Can you tell us a little bit about yourself?
Yes, absolutely. So I started Moatti Capital 6 years ago. My background before that, I was born and raised in Paris, France, where I studied electrical engineering. And right after that, went to get my MBA in the Bay Area at Stanford and spent the first decade of my career as an entrepreneur and product manager. I built products that today billions of people are using. They won some nice awards and worked for large companies like Meta and Nokia and Electronic Arts when I wasn't building my own. I started investing about 10 years ago as an angel investor, had some early successes, and started Moatti Capital 6 years ago as a result of having some good investments, meeting some really strong partners, and having also a very competitive advantage in venture, which is a global community of 500,000 product managers, which bring us a lot of deal flow and bring a lot of value to our portfolio companies. And I started this community from my operating career as a product manager. So that's really what makes Moatti Capital unique. And what we do, we invest at Series A stage in B2B tech for the most part. We've invested in companies you'll have heard of like Amplitude, Grok, DigitalOcean. We also invested in B2C at some point, so we're investors in Airbnb and a few others.
Wow, that's incredible. What attracted you to the private equity and finance space, given your electrical engineering background? That's a wild transition.
I know. Absolutely. In fact, when I transitioned and had those early successes, I made the mistake to assume that every product person can be a great investor, which is absolutely not true. It's the exception rather than the norm. And so, when we think about bringing talent into our team today, we really have developed a lot of different programs to identify great product minds that also have the potential to be disciplined investors. We have a product executive in residence program. We have fellows program. Because of what you're describing, it's not a very natural transition. So how I went from here to there, I did initially the thing that a lot of people do in Silicon Valley, which is do angel investing. And as I met really great investors around me and learned so much of what I do now from them, I also started teaching investing at the Stanford Executive Extension Program, where I met even more investors who I started to collaborate with. And then as I started investing and having these successes, I joined the board of some of the companies. And same thing here, you see a lot of dysfunctional boardrooms. So I started teaching governance at Stanford at the executive school. And I started to meet outstanding board members this way. And so, kind of step by step, you become part of an ecosystem. And next thing you know, I briefly worked for a venture capital firm, like a kind of a traditional old dinosaur. And once I saw how they operate and how inefficient they are and how not scalable business it is when you don't have a competitive advantage, it was a kind of a pretty easy step for me to say, I have a true differentiator. I have some track record. I have great partners. I'm going to be better off doing it myself with my partners. So that's what we did. What's interesting about starting a firm is that I'm an entrepreneur as well as being a venture capitalist. And I will say it's the hardest job I've ever had, to be a venture capitalist. A lot of times I'll tell an entrepreneur, like, I can't meet in person this week because I'm traveling, and I'll get an answer like, okay, great, enjoy your vacation. And I work 6 days a week and really hard because just like them, right, I'm also building the company. I'm creating the culture. I'm looking for the right team. I'm constantly thinking about, how do I get the best people? How do I keep our differentiation alive? How do I get into the best deals and really grow the firm into a category defining franchise? But in addition to the business building that I did in my previous life, where I was a tech entrepreneur, as an investor, I have 30 portfolio companies that rely on me and on my partners for guidance. And so in a way, like, I feel like there's an element of running or advising so many companies that are at such different stages of growth and maturity. The context switching is massive. So I kind of left it as like, there's all this context switching, and that makes it like a really difficult job. Another really exciting aspects of building a venture firm is that the cycles take so long. It's well known that you're raising a fund, but it's only 10 years later that you'll know if you did a good job or not. And so for us, when we were thinking about building a firm that's differentiated, that's more capital efficient, more customer oriented than the old dinosaurs and the kind of the established firms, one of the things that we thought about was, how can we generate some early exits as a venture capital firm so that we bring money back to our investors faster than other venture firms. And I'm very proud of that. We've been able to send checks to our LPs every single year for the past 4 years. So it's only the first 2 years of existence of Mighty Capital that we're net negative. Like every year, every single year after that, we've been a net positive. And we make about 5 investments a year. So in 6 years, we've made 32 investments. 10 of them have already exited. And when I say exited, people may imagine, because they think of VC as the traditional old school power law of you get like 1 in every 20 winners or so. We only have 1 write-off in the 10 exits. Like the other 9 have returned anywhere between 1, 2, 5, 10, and 15x. We've had the really good fortune of taking a different approach that essentially breaks the traditional power law. 1 in 5 of our companies is an outlier as opposed to 1 in 20 that people are used to. And that makes a big difference.
That's a huge difference, especially for your investors. And I mean, seeing that track record, that must give them a lot of confidence. What do you think have been contributing factors to your success? Is it the familiarity with products? Is it the relationships you've built? What do you think are the strongest factors in that?
Yeah, I will say it's a combination of things. The first one is we are good pickers. We pick a lot of great winners. And one of the reasons we do that is because we have a platform of 500,000 product minds that are helping us predict innovation trends before they become hypes. So that's how we were early in product-led growth with our investment in Amplitude that went public on NASDAQ a couple of years ago. That's how we were early in generative AI with our investment in Grok, who's been in the news a lot in the last year, but we invested way before that. And so every quarter we publish innovation insights that are based on the learnings from our advisory board and from the bottoms-up signals of 500,000 product people who constantly send us new products. Like this year, we've already received 6,000 nominations for our product awards. We give awards to great products every quarter or so. And that platform is very scalable. Like if I look back 5 years ago, we only received 600 or so nominations. So 10x growth in the last 5 years. And it's also trusted by amazing brands like Capgemini and Johnson & Johnson and Walmart and Cisco. So it makes it really scalable for us to find these trends and therefore find investments early. So we pick better as a result of that. And then the second aspect is we also win those deals more often because one of the big challenges from being a tech entrepreneur and transitioning to being an investor is my product is a complete commodity, right? I bring money to the table like it's just a green dollar bill. But if I'm able to make my dollar look greener, then I have a real edge in the market. And what we offer to these entrepreneurs essentially is we help them sell more and faster. And how we do that is really something I learned from them, which is post ZERP and post COVID pandemic, they have to completely reinvent enterprise go to market because since nobody goes to the office anymore, like cold calling doesn't work as a lead generation channel. And since AI is sending everyone like hundreds of emails every day, nobody reads email either. And then traditional budgets like marketing and engineering and finance are decreasing. And so the traditional ways to put leads in the pipeline are gone. And that's the number one concern for entrepreneurs. Now, on the other hand, product managers are now involved in almost every single technology purchase decision in enterprises. And so when we expose entrepreneurs to 500,000 product managers, they see that as a massive sales channel. And we help them adopt a product first strategy to their go to market, which is very much based on referrals, like having a great product, strategically thinking about whole products. So doing some M&As when it makes sense, changing the business model to make it more aligned with like their customer needs. So business model innovation. And so by doing that, we are like our win rate is massive, right? Because entrepreneurs see us as a dollar that will get them so much farther than a dollar that does not come with a distribution channel at scale. So that's sort of the combination of because we have access to way more investments and innovative companies, and we kind of have a scalable mechanism to predict the future a little bit, and because we add more value, we are able to get that 1 in 5 ratio that really kind of is in a way, that's the exception that confirms the power law, right?
So you're picking winners and you're helping them win.
Exactly. We like to think that we're category kingmakers for some of our companies. Yes. In fact, they tell us my sales cycle has accelerated by 30%, like sales velocity, right? Is massive. Or you've helped me add millions of dollars to my revenue line, or you've helped me go from like a single point to point, solution to a massive platform across industries. These are the types of testimonials we get from our portfolio companies.
There's probably a lot of trust there too, because of your background, that you can establish those connections. And it's probably a lot. It's not just someone coming to the table with money, it's someone coming to the table with resources, with access to funds, with access to relationships, and with knowledge of the space, which is a lot of people probably aren't coming to the table in the same way.
Yes. Absolutely. And what's interesting is we're 7 on our team, 2 co-founders and an investment committee, and then 3 partners who sit on the board of some of our companies on our behalf, and then 2 principals. And every single person on the team has very successful operational experience, which means that when we sit on the board, we can really help those companies be successful. And then that combined with the distribution channel we offer, you're right, there's a lot of trust that gets built, especially because the conversation is, what are the challenges in the go-to-market? How can we help solve them? Which is sort of the opposite of what often people or entrepreneurs are comfortable sharing with their board, right? They want to bring only the good news. But if they realize that their board members are actually going to help them deliver on their sales target, then they become very, very transparent. And it's been great to see that evolve and being a partner to these entrepreneurs more than anything else.
And a collaborator with finding a solution to the issues rather than just putting something else on their plate to solve another issue when they probably already have a stack of things that they're trying to resolve in their product.
Yes.
Makes a lot of sense.
Exactly.
So with this platform that you have, I mean, what trends have you been seeing in the last year? How do you expect those to change in the next 6 months, 12 months, 3 months?
Absolutely. And those trends, you're right on point, Kelsey, they change every quarter. And so what we do, to give you a sense, right, we get these 6,000 nominations, and then we have hundreds and kind of thousands of privileged relationships with product executives, and we create those quarterly trends. From there, we do a very thorough investor due diligence. So we kind of put the product cap off and the investor cap on, and we'll create about 30 to 40 theses every year. And a thesis is based on one of those themes, and we'll look at what are the KPI of success in that particular segment, who's investing, how much, what are the multiples, who's acquiring, what are the multiples, who's going public, who are the key influencers, how much value can our product platform be adding to the table. And then we'll look at a market map of about, say, 100 or so companies per thesis, and we'll make 5 investments or so every year. So some of the things that we're looking at right now are sort of the picks and shovel of the next wave of AI. And we're happy to talk about like our contrarian perspective on AI in general. It has a lot to do with data infrastructure, data governance, data security, some like specific verticals in enterprise AI. These are some of the segments that we think are really interesting this particular, like spring, summer of 2024.
What's the contrarian perspective? You've piqued my interest on that.
So a couple things, right? If I think of the innovation life cycle in AI, there are two sort of trends that go against one another. The first one is when you think about like what are the massive breakthroughs, right? The phases of innovation. When you compare AI to mobile, for example, it goes really slowly. Like the first key AI breakthrough product was IBM Watson, which was about 15 years ago. And so it took 15 years to go from like a Watson, which is really like that super intelligent machine, right? It's not human at all, that can solve problems that nobody else could solve before. It took 13 years to go from that to OpenAI, ChatGPT, which is no longer quite so much a machine. It's not very smart human, if you want. Human that is odd, right? Like will have very good user experience, will be delightful, but will not really kind of understand exactly what you're saying. And when you compare that to the mobile era, the first smartphone was this massive brick. It was actually also created by IBM. It was called the Simon. And it only took 6 years, right? Not 13 years to go from that to the first Nokia smartphone, which had 3G, which enabled like internet connectivity and was much smaller, like fit in a hand. And then it took another 6 years to go to the iPhone, which was all about personalization. I had my own music, my own app store, and so on. So the cycles are 6 years. With AI, I'm looking at cycles that are 13 years to go from one breakthrough to another. So it's very slow. But then on the other hand, the level of innovation that we're seeing right now is unbelievably fast. Like to give you an example, the 6,000 nominations we've received, 4,000 of those, so 67% are AI companies, compared to last year, 20%. And then the year before, it was non-meaningful. And the entrepreneurs who are innovating at the right speed, they're serial entrepreneurs. They've played the game like 3, 4, 5 times. They can play it so fast, so efficiently. And that's the only way to keep up with the speed. So it's like goes really fast and goes really slow at the same time. And then when I think about the current cycle and the hype we're in right now, I'm thinking like, what's going to make the music stop? And I think of 2 key risks. The first one is sort of like a Napster risk. You've seen lawsuit from the New York Times and a few others against OpenAI. And your New York Times says my content has value, and I've proven it. I have a very successful subscription service. And therefore, OpenAI, you should pay me for it or for using it. And OpenAI says, no, it's like copyright law. I don't have to pay for anything. And if it's just those two, then it doesn't really matter. But if all of a sudden, the New York Times, The Economist, the Wall Street Journal, like all the publications, all the media companies say, well, you know what, like OpenAI, I don't want you to use my content anymore, then the value of OpenAI all of a sudden significantly decreases. And so the question is like, is OpenAI kind of like a Napster, which is necessary to give birth to Pandora and Spotify and Apple Music, but is Napster? So that's one key risk. And then the other one is an interesting one because I think of a Global Crossing and WorldCom like 20 something years ago, which resulted in the Sarbanes-Oxley regulation, where companies were essentially inflating revenue artificially. Like, I'll buy your stuff, you buy mine. We're going to kind of let it sit there, but our revenue are going to do great. And what's happening right now with AI is very similar, where you see cloud companies like Microsoft say, hey, I'm going to donate, I'm going to gift you, grant you hundreds of thousands of dollars worth of credit, and then you'll spend them on my platform, right? So they're giving it to get it back. And when the music stops, then like what's real is sort of a big question. So I think these are some of the key risks around the current hype with AI.
Wow. For the first one, that comparison to Napster's wild because I mean, there's so many like the copyright law, like the rights to the information, like what information are you putting in, that go right along with that. Because all of those resources that you mentioned, like the New York Times, all of these publications are the ones that are still vetting their information in a very, very old school manner in order to make sure that what they're putting out there is correct and accurate and factual.
Yes.
And so, like, those resources have to be incredibly valuable to AI as something to compare other information against almost, or to use as a resource in answering questions.
Yes. This year, it's especially true because we're going to be seeing so much disinformation with all the election. But even like with the current geopolitical climate, right, it's not just 2024, it's going to be the next, whatever, decade where Russia, China, US, like every country has an incentive to send and produce disinformation campaign to create revolts, uprisings, instability, because the world is just kind of going in that direction. And so the fake news, right, that you're referring to is becoming a real phenomenon where people don't trust information unless it comes from these trusted sources. And that's why you see these media organizations be so successful with their subscription models, right? Like 5-10 years ago, they were giving their content away for free because people weren't really valuing it. But now they're saying, actually, I'm going to pay the New York Times because I know they're going to do something to vet whatever they put out. It's going to be very interesting to look at this because the music industry is way more mature than like the media industry in that fashion where like, they had to do that like 50 or 100 years ago during the time where the radio was starting to become big. And it's like, well, if you play one of my songs, how much money am I going to get? 2 cents, half a cent, like who knows? But they had to figure it out a long, long time ago. And now media is going to have to figure it out as well. For firms like McGuireWoods and great law firms, there's going to be a lot of really exciting problems to solve around AI over the next few years. And whether it ends up being regulated or not, I joke that I put a reminder in my calendar in 13 years to check on AI regulations, because I don't know that we're able to really like think through that from such a holistic, compliant perspective, but on a case-by-case basis, right? Like the work that you're going to be doing at the firm, I think there's going to be a fascinating time of trying to define innovation in a really, really new way.
And as slow as comparatively to mobile tech, as you mentioned, AI was the legal system and Congress and all of the lawmakers in the country are even slower. So it's probably
Exactly.
different
Yeah.
before anyone can even like regulate it. Although I know people are trying to get their hands around it.
When you project that a little bit more, if you say, okay, so the world is going to split in two, right? There's going to be the super vetted content that may be more expensive and that will sort of be the next gen of like an open AI, but that will, charge for content. Maybe there's going to be one path there. And then there is also going to be a path of like, no, everything has to be free. Access to information has to be unlimited. And if you assume that this path is going to be more prone to disinformation and fake news, then the funny aspect is the way you flip it is you say, well, if I have fake news or disinformation in a fake environment, maybe it's less fake because everything is fake by definition. And so all of a sudden you're starting to think about like metaverse, right? The artificial 3D environment as a place where all of that can actually exist without being odd, right? Because it's already a fake environment, or so content and information being fake is less dissonant than in sort of a real environment. So that's one way that you can play with that innovation. Another way that you can play with it is to say, where does it make sense to create content by an AI and it won't be awkward? And there, I think one of the very vulnerable industries is movies and entertainment. Like if I were Disney today, I would be really concerned that a company is going to come and do something like what Pixar and Netflix did a couple of decades ago, where instead of having my core business be, I have the best animators, the best script writers, and I create entertainment experience that are just second to none, all of a sudden, all of that is replaced by an AI. And so it's not just that I'm optimizing my customer support with AI and reducing costs, it's that I have to literally completely recreate my core business if I can, right? And if not, I'm going to be disrupted by a version of me that is going to look nothing like me. And that I think is also really exciting because so much of that content creation can be automated, can be done faster, can be done more personalized, can be done more realistic, and then can be also sold in completely different ways, right? Why would I sell a 2-hour movie or a 10-episode series when in fact I could sort of create an adventure that I get to be the hero of, right? Like those books from way back when, but in a real environment, because AI will sort of personalize the experience just for me and just for you. So there's a lot of sort of exciting innovation to look forward to in the next decade with AI.
Wow. Like living in a choose your own adventure Disney fairy tale or whatever kids will have access to. Oh my God. And personalized to you.
Yes.
That's like a completely different form of entertainment. And I think, you use Disney as an example, but like that's so imaginative. It lends itself so well to certain age, like, I mean, for adults too, but also for children in certain developmental stages. Like you're very like focused on imagination and creativity and things like that. And that's just like an absolutely like never ending resource for that.
Yes.
Wow. What a playground.
Yes. So entrepreneurs are going to have such a blast, right? Like if you think about what they could do with AI. And actually that brings me to another sort of interesting point, which is, I mentioned there are 4,000 companies out of the 6,000 we receive nominations from that are AI companies. Most of the companies are still focused on relatively incremental uses of AI, right? Like the call center optimization, like the type of thing. And if I think about like, what are the problems that AI should be solving because humans can't, I think of things that are like much, much bigger, actually. I think of, in fact, three. One is self-driving cars, which we're still trying to figure out, but AI can solve that, and humans and algorithms, it's a lot harder. Two is drug discovery. And we're starting to see a few pitches around that, but I think there's so much more that can be done. And then three is loneliness. And when I say loneliness, I don't mean just dating. I mean people being isolated because they're older, because they work from home, because there are lots of different reasons. And an AI can really be a true companion for mental health, for aging people and stuff like that. And AI, with the personalization that it can provide, can be a really great solution for that. So I would love to see more entrepreneurs tackle these big problems that only AI can solve, as opposed to playing with the more sort of incremental productivity or cost efficiency type of solutions.
I think the loneliness one in particular is such an interesting, I mean, we just have people living for so much longer and all different stages of health and things like that. My grandmother's 96 but she's very tech savvy. It's like incredible. She's on all different social media platforms. She uses Alexa, but it's such a different experience at her house. She's so polite to Alexa. I think there's so many different ways that could really be helpful, especially as people are living longer in different stages of health in particular. That's very interesting. So do you have any insights as to women-led equity funds, securing investments, strategies for overcoming gender-related biases in fundraising?
Yes, I do. And thank you for asking this question, because one of the things that I found, I mean, it's no secret, right? Like there's like 2% of women who are founding their own firms, and most of the capital goes to the guys and so on. So I'm not going to rehash that. But what I found is we are in the final stages of raising our third fund. And when we pitch to LPs, regularly we hear like, oh, okay, well, since you're women-led, you're eligible for our diversity bucket. And so here's that tiny little bucket over there where you can get, a small check from us simply because you're a woman or you're women-led. And so we have now learned to be very proactive and say upfront, like before it's even sort of part of the consideration, to say, look, despite being a women-led firm, we are playing actually better than the dinosaurs. And so we do not want to be pigeonholed into a diversity bucket. We want to play with the big buckets because we are very ambitious and we want to be scaling. And when we say that and we're relatively upfront about it, the reaction is really positive. It's like, oh, yes, that's entirely fair. And my hope is that it encourages LPs to think more as like an emerging, like right-sizing their investment, like an emerging manager as opposed to a woman, therefore an emerging. Because now we're in that scaling stage. We want to be going after larger checks. And I think that's an extra challenge for us to overcome the fact that we could fit in the diversity bucket, even though we don't have to.
Some of those programs you would think would be helpful, but you're right. They're automatically maybe thinking, okay, well, this is the check size we typically write when we have a diverse applicant. And that's setting you in a pool that you don't want to be in. You want to have access to the same resources and funds. And sure, that can be part of the check that they write, but hopefully it's part of a bigger whole, especially given, like you mentioned, your success rate and track record with your investments in the last 5 or 6 years. So, SC, we always ask our signature question at the end of our conversations on the podcast, and that is, what advice would you give your 22-year-old self?
Yes, absolutely. I love that question. What I would say is very simple. Is you are ready. Growing up, it took me a long time to build the confidence that I needed to start my own business, to express my ambitions fully and without feeling bad about it, right? And that sentence, I actually still have it as a sticker on my computer, like, you are ready. There's nothing more to learn. And at the same time, of course, there's so much to learn, but there's no reason to wait to do what you want to be doing.
I think that's really true. It's hard that's often a stereotype kind of. I know it's true for me that I have trouble raising my hand if I am not sure I'm 100% perfect or I'm 100% right on something. But just making the effort, putting yourself out there, being confident in what you do know, being willing to learn more is really what all of life is about, let alone business. So being confident in what you know so far is such great advice. Well, thank you so much for your time. I really appreciate it.
It was really fun. Thank you for a great discussion.
Thank you for joining us at the table for this episode of Deal Us In. If you have a recommendation for an inspiring interviewee, A question you'd like us to ask? Or topic you would like to hear covered? Or if you'd like to tell us about women-focused initiatives in the field, please email us at wpef@mcguirewoods.com. We look forward to hearing from you. This podcast was recorded and is being made available by McGuireWoods for informational purposes only. By accessing this podcast, you acknowledge that McGuireWoods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in the podcast. The views, information, or opinions expressed during this podcast series are solely those of the individuals involved and do not necessarily reflect those of McGuireWoods. This podcast should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.